And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. It is, of course, Hump Day, which means that Danny Ratliff is going to join me this morning. We're going to talk a little bit about, end of the year stuff, right? Gift giving, taxes, all that fun, holiday cheer stuff. Everybody likes to address this time of the year, tax loss selling, all that's coming up here. So anyway, a few things to go through this morning. Markets have been just, very, very exuberant here over the course of the last month. In fact, we had, as we've talked about this week, it's been some of the best November since like 1930. It's been quite phenomenal how strong this rally was post the election. And again, while people talk about this like, oh, it's, this is great, it's very bullish, yes. But there's a few things just to kind of pay attention to that suggest there's also a little bit of risk. As markets go up, you do start to build risk into markets of a correction short term. Nothing can go straight up forever, right? Trees don't go to the sky. So when markets get very exuberant, that increases the risk of a correction. And we can look for some indicators that may show us, kind of what that risk is. One of those is how many people are short stocks in the market, right? So technically, there's a buyer and seller for every transaction, and if I'm running a hedged portfolio, etc., I might be long some portion of my portfolio, short others, right? So I'm selling stocks I don't own on a bet that they might actually go down in price. Short sellers are at the lowest level basically since 2004 at this point. So what has happened here in the market since March is that we have pretty much gotten rid of most of the short sellers. People don't want to be short in this market simply because, markets are very bullishly biased really ever since March because of all the liquidity and the stimulus, et cetera. You certainly understand that, but exceedingly low levels of short interest basically provide a setup for a big correction in the markets. And in fact, if you take a look at what's been driving the market here as of late, the most shorted stocks, right? So there's still some short people out there, but the ones that have the heaviest short positions are the ones that have been rising the most. And this makes sense because as prices go up in the market, then I've got to cover that short position. So I've got to buy the stock to cover a position I sold short, which increases the buying in these stocks. And this is why we're seeing some of the most fundamentally weak stocks, so the stocks that have the weakest fundamentals, actually rising the most. And we've seen that a lot in the market over the course of the last month, and that's because of a lot of the short covering. But again, when we take a look also, this is also pushed into this idea, every stock is bullish, no matter what you buy, it goes up. So people start just buying kind of everything, right? It's just, that went up over here, so now I'm going to buy this. Well, that starts pushing all these stocks up above their 200-day moving average. So this is the average price of the stock over 200 days. And that level of stocks above their 200-day moving average is now at 93%. So basically every stock, for the most part, is now above its 200-day moving average. And this is important because this is, again, kind of a representation of a very bullish market. In fact, when we get to these kind of levels, typically you have corresponded with at least short-term market peaks throughout history. Now, it doesn't mean you have a big correction. It doesn't mean you have a March 35% sell-off, but a 3 to 5 to a 10% correction, certainly well within the norms when you have this much bullishness, so to speak, in the markets. And again, speaking of bullishness, our good friends over at Sentiment Trader produces a great chart. So this is basically a chart showing a combination of indicators that represent both bullish, people being exceedingly optimistic about markets versus pessimism. So right now, investors are more optimistic than just about any other point in history, right? So no matter kind of when you start even looking at a combination of optimism in the market in terms of various indicators, when you combine all those together, those have all pushed up into a level of more extreme optimism. Those typically tend to associate with short-term market tops. And one of the associations of investors that people look at is the AAII. It's the American Association of Individual Investors. And all through this year, this was kind of an interesting phenomenon. After the March crash, the market began to recover, lots of stimulus, but the AAI investors remained very bearish until last month. And in November, they became exceedingly bullish. In fact, their bullishness jumped to basically a peak for the index here just in a month as they kind of the last of the laggards come, kind of back into the markets. And again, this is what happens towards at least short-term peaks in markets. You start to drag in the last of the holdouts, right? They all come into the market all at once. And again, taking a look, if I really want to speculate on markets, should I say, one of the great ways to do that is through the use of options. And these are contracts that you can pay for. You pay a little bit of money to get exposure to a larger stock amount, and it's a lot of leverage, right? And these option contracts expire at some point in the future. Right now, options speculation is back up towards some of the highest levels that we've seen, really not just on record, but just in recent months as well. And taking a look at what they call the put-call ratio. So this is the number of people that are actually buying puts on stocks, betting that they'll go down. They've evaporated. Just like short sellers have gone away, so have put buyers. Nobody's worried about a crash at this point. Everybody just assumes that markets are just going to grind higher. In fact, we have targets for the end of the year now at 4,000, 4,200, 4,500. By the end of this year, Jeff Sout over at Raymond James saying we're going to have a 10% return in the month of December. That's a pretty large return for a single month, considering we just had a 13% return in November, which is basically 2 years of gains in a single month. So, when you have this kind of, again, back to this idea, I can't lose market, you get to a point to where people simply just stop hedging risk in their portfolios entirely. And this is interesting because now with markets at all-time highs, we're doing great. Everything is fantastic. Consumer confidence remains very low at this point. In fact, consumer confidence has not really recovered much from the lows. We're still seeing record jobless claims every month, 700,000 plus every week. I'm sorry, not month, but every week on jobless claims. The real underlying economy is still got trouble. And this is why we're still talking about doing stimulus talks, trying to get more money out to the economy, because if we don't do that, well, the economy's going to have trouble, but yet markets, who cares about the economy? Let's buy stocks because everybody's making money in the markets. And this is the interesting point. While everybody, your next door neighbor and all your friends are at dinner parties talking about all the money they're making in the stock market, smart money, which are your professional investors, have been slowly walking out of the market going, you know what? Y'all can have it. In fact, here's my shares. I will sell them to you. So you can buy all my shares at this point. And the same thing, we've seen that with insider selling. Corporation owners are selling their shares at a record pace right now. So while you're out there buying all the shares of stocks that you can find, smart money has been walking out of the market very quietly. The point about this is that simply, when we get to these kind of points in the markets where everybody's exuberant, everybody's in, everybody thinks it's a can't lose market, that's about the time it's a can lose market. So just pay a little bit of attention here. Markets hit a record high yesterday. Absolutely a good sign. Again, we kind of popped up yesterday on expectations. Again, first day of the month. Everybody's kind of very bullish now in the markets, want to be in. I got to be in this market right now, particularly because it just kind of keeps going up no matter what happens. Doesn't matter what the economic news is. Doesn't matter what the virus news is. All these do have implications ultimately to earnings, which will ultimately be important. So again, it is worth paying attention to some of these other indicators that tell you there's a little bit too much exuberance in the market. There's a little bit too much of that I can't lose attitude in the market. And typically that is about the time that something typically tends to go wrong. Doesn't mean go sell everything and go into cash, but it certainly suggests taking a little bit of risk off the table, which is what we've talked about here over the last week or so in our portfolios, taking a little bit of money off the table, raising a little bit of cash, just being a little bit cautious. We'll be right back after the break, though. We're going to pick up with Danny Ratliff, talk a little bit about year-end strategies, what you need to do. That's coming up next on The Real Investment Show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Long-term care is the financial elephant in the room. The median national cost of a private room in a nursing home? $8,517 a month. Are your finances prepared to handle that burden? Our next Candid Coffee with Richard Rosso and Danny Ratliff can show you how to protect your finances from the effects of a long-term care event, the myths to ignore, and how to prepare a plan to address the cost. Register for the special long-term care edition of Candid Coffee, Saturday, December 5th at riaadvisors.com.
You're listening to The Real Investment Show.
Morning and welcome to the show. 6:17 this morning. Danny Ratliff, certified financial planner, joining me this morning. Talking to us because it's that time of the year, right? I mean, Christmas just around the corner. You know, it kind of sucks this time of year because my wife's birthday was yesterday, right? So she has her birthday, and I've got to turn right around and try to figure something out to buy for Christmas. Now, she's making this easier for me now. You know, Amazon is making the world an easier place to live, and if you use Amazon properly, it'll save your marriage. Because what I have my wife do now is just put all the stuff she wants into an Amazon list, and then I can go in there and just pick and choose out of that. So I always know I get the right size, get the right item, it's the right color. It's you know, instead of asking your wife, what do you want? They'll always say this, like, oh, you know me, just, you know, whatever's fine. Mm-hmm. Yeah. Mm-hmm. I know better. Or better this one, you know, don't worry about getting me anything. I'm good.
I've got everything I need.
I know, right?
I love how you've moved on from Nicole picking out your Christmas gifts now.
Yeah, well, that was the smartest thing I ever did was getting. So McCall works at our office, and I got her to pick out my wife's purse one year because you know, if you buy the wrong purse,
well, she's got impeccable taste.
Exactly, and I learned that lesson.
But a little bit more expensive taste I think Lance is going for.
Don't ask McCall to pick out your Christmas present because the price tag comes with it.
It's impeccable taste with unlimited budget.
Exactly. So that was a lesson I learned pretty quickly.
So now you're like, honey, just put it in the Amazon cart. Yeah, it's on sale.
I will tell you what, though, that purse got me mileage for the next year. So,
well, I guess you do luck out a little bit because if you get her to put things in there early enough, you had Cyber Monday, you could take advantage
exactly.
of.
Exactly right. And you know, so it's worked out well. So, but the point here is, you know, this is you know, kind of marriage tip 101. If you need a new can opener, don't buy one for your wife for Christmas. Just go buy one. Yeah. We have a friend, Britt and I have a friend of ours that bought his wife a vacuum cleaner for Christmas. That almost ended their marriage.
Do you know what? My wife would prefer the vacuum cleaner over like a diamond necklace. Like, no kidding.
You think that?
I swear to you.
I would.
I tell you what. You try that.
You go first.
Yeah, you go first. And if not, I have a couch.
In fact, I guarantee you that if I tried to show up, and we can play this game, that if I gave her a necklace for Christmas, she'd take it back. But if I gave her a vacuum cleaner, if it was the one she wants, she would be tickled pink.
There better be a necklace wrapped around the handle of that vacuum cleaner.
Yeah, touche. Fair enough.
Exactly. But anyway, the point is that we are getting into that, you know, time of the year where we are in gift giving season, and this is also the time of year where we also have to start doing a little bit, unfortunately, you know, kind of boring stuff to talk about, but, you know, kind of the year-end tax planning stuff, right? Things you need to get wrapped up here before the end of the year. Importantly, this week and next week, we've talked about this on the show for the last couple of days, but mutual funds are about to start distributing out their capital gains, then their interest income for the year. And depending on how you invest in mutual funds, if you do a dividend reinvestment, so when the mutual fund issues out their dividends or interest, that if you're just reinvesting those, then you're going to get new shares of the fund, right? They get reinvested back into the mutual fund. If you don't do that, if you take your distributions in cash, then you're going to have a check show up into your bank account of some money of these dividends and interest. Here's the thing you need to be aware of, because Danny and I get the same phone call 50 times every year from the same people. You're going to wake up one morning and your mutual fund's going to be down $1 or $2, depending on how big the distribution was. And you're going to be like, what happened to my fund? The market's up today and my fund's down $2. What happened? That's the distribution. In a couple of days, just be patient. Don't freak out, because in a couple of days, it'll all work itself out. You're going to get a cash deposit or you can get more shares of the fund. But there's going to be a gap of about 1 to 2 to 3 days, depending on, you know, the processing time of this, before it works itself out. But by the end of that week, the value of your portfolio will return to normal. So if you own a lot of mutual funds, A shares, B shares, C shares. Now this doesn't apply to ETFs. This doesn't apply to individual stocks. This is only about mutual funds. If you own mutual funds, you're going to have this distribution issue, and you're going to see a lot of volatility in your price of your funds for a couple of days. But it's going to work itself out. It's just part of the normal process. But we get these same phone calls every year, people trying to figure out what happened. It does happen with stocks. Costco is going to issue out a $10 special dividend this week. So you're going to see the shares of Costco drop by $10. And then depending on whether or not you reinvest, have an automatic dividend reinvesting into Costco, or whether you take cash, you're going to get cash or new shares of the stock. So one of the two, right? So there you go. But this does talk about this time of year that we also need to start talking about kind of year-end cleanup. So this is time to start doing things like tax loss selling, charitable giving for taxes. This is particularly important with potentially this idea that tax rates may go up in the next year. Also, just kind of other year-end tax planning, kind of cleanup, portfolio planning, et cetera. Danny, what we need to be paying attention to?
Well, I think one of the big things that we've been discussing is that tax loss harvesting. So making sure that you can offset some of those gains. Now, one of the other things that we've looked at this year and talking to lots of different CPAs is that there's the potential for higher taxes in the coming years. So we're actually having conversations with some CPAs who are saying, you know what, go ahead and take these taxes, pay capital gains on this, even if you can't offset this, because the word has been, or at least what Biden campaigned on, was that he was going to potentially change capital gains taxes where most people are going to pay about 15%, to where it's going to be ordinary income. So you could have the potential to pay a much higher tax rate on these capital gains longer term. So we're even having some conversations where we're saying, you know what, go ahead and take these capital gains now. Markets are at all-time high. So from that type of perspective, it may not be a bad idea anyways. But go ahead and reap some of these gains that you've had over the last 6-7 months and pay taxes now, because you're likely going to pay a much lower rate currently than you will longer term. And so, the dynamic from the investment standpoint of where things are at the moment, I think that's a big thing. The other thing you may want to avoid is, from a tax standpoint, avoid purchasing mutual funds right now, because if you're in that time frame, you could get into a fund and then you could turn around and have this distribution happen. Mm-hmm. It's going to be a taxable event, and you didn't reap those benefits from being in the fund all year long.
But you had a taxable hit.
Correct.
Right. I mean, you'll get the distribution, right? Like and people do this all the time. They try to buy a stock for the dividend, right?
Correct.
But they buy a mutual fund, and then at the 1st of December, and then like 3 days later, they get a distribution of gains and interest. Very cool, but that's also a taxable gain that you've got to pay tax on. Now, importantly to what Danny's talking about, of course, is that look, we've had a lot of gains since March, right? We've had a very big year from the March lows. But those are short-term gains versus long-term gains. So you also have to do a little bit of your tax planning, as to whether or not you're selling, short-term losses to offset short-term gains, or long-term losses to offset long-term gains. So part of that is part of your cleanup strategy as well for the end of the year, just trying to get your portfolio in a position to where you're kind of set up going into next year. And if we do have a change to tax law. And again, this is going to be one of the interesting things, is that under the Biden administration, he's talked about raising taxes on people making over $400,000 a year. Ironically, those are the people that normally have the majority of the investments in the markets. So raising, changing, capital gains distribution from a special rate, a lower rate, to, normal income, certainly has a lot of implications, and it's not just the fact from a tax standpoint, it also changes investment strategies to a large degree. If capital gains no longer have a preferential tax treatment, there's no reason to hold a stock longer term to try to get that lower tax treatment, right? So this potentially has an impact on creating more volatility in markets, shorter holding periods for stocks. It used to be back in the 60s, the average holding period for stock was 8 years. Today it's 6 months. And if you change this to everything being normal income tax, you're going to drop that holding period to, a month to 2 to 3, maybe less, because there'll be no incentive to hold things longer term for favorable tax treatments.
That's right. And so, those are all things to look at. I think another thing would be gift giving, especially those who are concerned with the estate tax down the road. So those who may have significant sums built up, you have to be cautious now because, there's ways to shelter quite a bit of funds aside. But the word has been that it's going to go down to about 3.5 million if all of these items are passed. And look, this is just what he's campaigned on. So we don't know exactly what this is going to look like here, 1 year from now or 6 months from now, or it may be even further depending on how things go here in the next couple of months. But we do need to be cautious, start preparing for these things. So there are things you can do. You can contribute or gift up to $15,000 each year without impacting the estate tax. That is something if you're married, you can actually double that, do $30,000. So something to consider. Another thing right now is if we're looking at tax strategies, depending on what type of year you had, you may want to delay. So the CARES Act allowed you to delay RMD, so your required minimum distributions. So this could be a great time to say, you know what? My tax bracket's here, especially if you're over 65, you're on Medicare, and that RMD may actually put you in that bracket where you're going to have IRMA or you're going to have basically surcharges. They're going to increase your premium for Medicare Part B. That's where we want to be cautious and say, hey, you know what? We can delay this for this year. Now, keep in mind, the more money you have in that account next year, you're going to have to take out a little bit more because that factor is going to change that the IRS gives you. So basically, they give you a number that you have to divide the balance that you have in your account on December 31st by this number, and that's what you have to take out each and every year once you're required to take your required minimum distributions. Now, the Secure Act, which passed this time last year, moved that number, the age, from 70 and a half to 72 when you have to start taking your required minimum distributions. But everybody has that deferral this year where you do not have to take it. You can start taking your distributions again next year. And there is lots of legislation out right now trying to extend the CARES Act or parts of it. There may be potential that they do the same thing the following year. I think it's going to be doubtful, though, with the way the market has reacted, at least here as of recent. But I still think there's going to be some, there's lots of things, lots of moving parts. Some of the safety nets are being ripped away as we speak. So we'll have to see what this month brings, especially with December 11th coming up, which that's a big date, and all of the additional things coming up. So we'll talk about some of this and more when we get back on the other side of this break.
Don't go away. RealInvestmentAdvice.com. That is RealInvestmentAdvice.com. Questions, comments, need help, got questions. Danny and I, happy to help you anytime at all. Simply click the Ask a Question button. Want to schedule an appointment? Happy to do that with you as well. We do Zoom meetings all over the country every day. So RealInvestmentAdvice.com. That's RealInvestmentAdvice.com. We'll be right back.
Listen anyplace, anytime at realinvestmentadvice.com.
Long-term care is the financial elephant in the room. The median national cost of a private room in a nursing home? $8,517 a month. Are your finances prepared to handle that burden? Our next Candid Coffee with Richard Rosso and Danny Ratliff can show you how to protect your finances from the effects of a long-term care event, the myths to ignore, and how to prepare a plan to address the cost. Register for the special long-term care edition of Candid Coffee, Saturday, December 5th at riaadvisors.com.
Got questions for Lance later? Ask now at realinvestmentadvice.com.
And welcome back to the show this morning, 6:33. Danny Ratliff joining me this morning. Brent, do you have any of those friends that, when you're right in the middle of watching like a series or something, they do spoiler alerts?
Oh, yeah.
Yeah. So I'm like 3 episodes into this new show on Netflix called The Undoing. Have you heard about this?
I have heard of it. I've not seen it.
Let me tell you how this ends.
It's Nicole Kidman and Hugh Grant.
Yeah.
And, she's a psychologist and he's a doctor. Mm-hmm. And this woman gets murdered, right? Yeah. And there's this, and now I'm not going to spoil it for you, but I just want to tell you a story. So yesterday, I've got a good friend of mine, Doug Cass, who's a professional money manager out in Florida. And so he writes a daily diary. He writes for thestreet.com. He has this diary that he writes every day. So he writes this article yesterday about the main character in this series called The Undoing on Netflix, equating that character to the Federal Reserve.
Oh, great.
Well, the problem is that he tells you who the murderer is in his article. He's like, yeah, I'm not going to tell you who it is, right? But it's one of the main characters in The Undoing, obviously, since that's the whole point of the show. It's one of the main characters, and they are the murderer. And this is a whole kind of suspense thing about Nicole Kidman. She's she's having to deal with this murder of her associate, and her family life is falling apart, and it just kind of shows her kind of melting down through this entire process. So he tells me who the murderer is and equates it to I emailed him back and it's like, well, thanks. I was 3 episodes in. Don't need to finish it now. But it's actually not a bad series so far, but it's kind of pointless to watch it now because I know who the murderer is. But anyway, don't do that.
Thanks, Doug.
I know, right? Don't ruin the show. There's not enough on to watch right now anyway. So anyway, just for the break, talking a little bit about kind of year-end tax strategies and gift giving and those type of things. And this is that time of year where, we need to start planning for next year. So a couple of things are going to happen, in the markets as well. One thing is that if there is a concern, and this really kind of goes into this idea of January in particular, if there's a concern that taxes are going to go up. And again, it's going to go up on, potentially those that making over $400,000. That's what they tell you. Reality is it'll go up on everybody because taxes get passed down. Debt and the whole idea of economic trickle down doesn't work. But the one thing that does trickle down is taxes. So the idea is that they're going to raise taxes. We got to tax the wealthy more. We got to do more of this. If they do pass a tax cut next year, the question will be whether or not it's retroactive to the beginning of the year or not. A lot of mutual fund managers, portfolio managers, pension fund managers, et cetera, aren't going to take that risk. So there is a potential that once we pass into January, right? So now we're talking about filing our 2020 taxes, that we could see a good bit of selling in January, February of 2021 to lock in whatever potential tax rates are there. And the assumption will be that if they pass a higher tax, it'll be for the next year. So in other words, tax rates will remain the same in 2021, but 2022, the next tax year, they will go up to a new level. That'll be the initial assumption. Now, if they make it retroactive, that's a whole different thing. Normally, it's the next year. Like even when we passed the tax cuts back in 2017, the tax cuts didn't become effective until the next tax year. And that's normally the way it does. So everybody's kind of banking on that year. So the point about this is that, one thing you want to do this year is to make sure and navigate your and harvest your losses against your gains and be tax efficient in your strategy. But then also be aware that in January, February, we could see some pressure on the markets if there is an idea that there's going to be a big push to raise taxes. So that's just kind of one of those things to kind of pay attention to.
Well, in the likelihood, it's probably going to be small that they're going to be able to pass some big sweeping reform, at least initially. If there's still, if Georgia, if the Senate.
I was going to say, it really depends. This all comes down to Georgia.
Correct.
Right.
Correct. So even at that point, though, what the word is, I'm talking to lots of different CPAs, tax attorneys, and a lot of the conversation is based around what's likely going to happen and then what could happen. And so we want to make sure that we prepare people for both scenarios. It's what's likely going to happen is that there won't be broad sweeping reform. It'll likely be that it's going to be more executive orders. They're going to piecemeal something together. But it can still have a significant impact. And so these are why these tax end strategies are so important in a year like this year or even next year. Now, the assumption is, like Lance mentioned, we're going to have next year, we're going to be able to get into 2021, and we'll be able to base, we'll have a little bit more accurate information that we can say, okay, it's not just hypotheticals. We'll be able to say, here's what's likely going to happen. Here's what we need to do now. The issue, like you mentioned, though, Lance, that it could mean that a lot of people will take profits, will do things they typically wouldn't, because they're trying to avoid larger taxes in the following year. Now, could it be retroactive? Absolutely. What's the likelihood of that? It's probably on the smaller side, I would suspect. Yeah. But the other sentiment is, if you talk to a lot of different people, is that there are a lot of seats in the House that are on the brink that were blued for turning potentially red. And, this is going to pose a potential issue, I think, for Biden that he's going to have to navigate. So I don't want to get political here.
Right.
But this could mean that that broad sweeping reform doesn't come in those first 2 years because they have midterm elections that you have to consider.
Yeah, 2022 is going to be important.
Correct. So, once again, we're kind of hypothesizing here some different strategies or different things that may or may occur. But we do want to be mindful and think about how these different taxes could impact you. And so that's why I think that some of these tax strategies, going ahead, taking some capital gains may not be the worst idea, especially if they did the retroactive where they came back and said, you know what, all of 2021, we're going to make it this new tax law is going to account for the whole year. I don't think that's likely, but it is possible. Some of the other things you want to do, make sure you're maxing out the 401k for this year. So take a look. Don't leave any chips on the table in regards to that. HSA contributions. This is a great thing. I've talked to a lot of people over the last couple of weeks who said, you know what, I didn't max this out fully. They're going ahead and maxing that out, taking advantage. That's the only account that's going to give you that triple tax benefit. We've written a lot about it. Richard Rosso has. I have on realinvestmentadvice.com. Go type in HSA in the search bar. These are great tools. IRA contributions. Now, you have until April of next year to contribute to an IRA. If you're not going to do it this year and you're going to delay it until 2021, make sure that wherever you go, your custodian is characterizing these things properly. We see a lot of times where somebody goes in January or February, or their CPA says in April, hey, you need to go make this contribution right now. Just going to lower your taxes a little bit. Well, that's great, but you need to make sure the institution is actually characterizing it for the proper year. I've seen times where it just doesn't happen properly. You think you're doing it for 2020, but it happens for 2021. And if it's too far down the road, they're going to have a difficult time recharacterizing that. Charitable gift giving. So this is a big one right now. Lots, especially with donor advised funds, given the opportunity to put funds aside, still have some control of assets. Remember with gift giving right now, especially with charities, charities have taken a little bit of a hit because the standard deduction went up so much, where it doubled under the Trump tax code, that a lot of times a lot of people weren't able to itemize those contributions. So keep that in mind. Talk to your CPA, talk to your financial advisor. If you need any help, like Lance always says, go to realinvestmentadvice.com, go ask questions. We have a lot of different information. I mean, we could talk about tax planning for years, but I see Lance drooling, falling asleep over here.
No. What? Huh?
Yeah.
But no, I mean, look, this, there's really two things too. Charitable organizations have taken a hit because of the tax situation, but they've also taken a hit because of people, just being more concerned about the economy. People are kind of reining in expenses and what they're spending and how they're spending and what they're gifting.
Correct.
But these charities depend. And this is one thing that's always interesting. Charities do a lot of really great work, and they depend upon charitable contributions for their livelihoods. And so it's always fascinating to me that, we've seen a couple of attempts by, over the years to try to limit charitable gift taxes and reduce the charitable tax deduction and these type of things. And, that's a horrible thing because, again, these charities, St. Jude's and others, they do fantastic work. They do so much good. In terms of research or medicine or just general health and creating a better society, that that's the one thing that regardless of what we do tax wise, need to leave that alone because they really depend on that money to a great degree.
They do. And so, we've talked about strategies on how to keep more money in your pocket. Now, there are some more strategic planning that we do quite frequently here, and that's looking at, should you be doing backdoor Roth contributions? Should you be doing a Roth conversion? This is a big one right now, especially with potentially higher taxes down the road. We've always thought there was going to be higher taxes. Now with the additional stimulus and more looks like it's going to be on the way here at some point, maybe not this month, but likely next. Taxes are going to have to go up at some point. So we want to be a little bit more strategic about that. Where do you put funds? How can you shelter yourself from these additional taxes down the road? I think this is extremely important in this environment. The other thing is like exercising stock options. That's one thing that a lot of people put on the back burner, and they think they're just going to do it in the right year at the right time. But if you have the ability to exercise them, maybe look at your tax scenario for this year, and maybe you want to go ahead. Don't let a tax bracket go unused or go to waste. So, if you have a certain amount that you can get up to, don't don't fret on going up a little bit. Try not to get to the next tax bracket. We're trying to keep people into certain areas where we don't get too high. You have a pretty good big jump from 24 to 32. And so if we can keep you under that, I think that's a good thing.
There you go. All right, quick break. We're going to come back, wrap up the show. Got a few little other topics to get into as well, just as we kind of look at where we are currently. Again, get by the website, realinvestmentadvice.com. Our latest blog post is out this morning talking about the narrative, and really, is the narrative kind of all priced into the markets already? That's on our website now, realinvestmentadvice.com, along with our technically speaking post and more, all there for you. Realinvestmentadvice.com. We'll be right back.
Listening to The Real Investment Show.
Long-term care is the financial elephant in the room. The median national cost of a private room in a nursing home? $8,517 a month. Are your finances prepared to handle that burden? Our next Candid Coffee with Richard Rosso and Danny Ratliff can show you how to protect your finances from the effects of a long-term care event, the myths to ignore, and how to prepare a plan to address the cost. Register for the special long-term care edition of Candid Coffee, Saturday, December 5th at riaadvisors.com.
Life is a series of events. How long will your retirement last? More importantly, how long will your retirement funds last? You can plan for a successful retirement with RIA Advisors' free financial planning tool, MyBlocks. It's our online modular manager for your money and your life. Does your vision of retirement match up to reality? MyBlocks can help to determine how much you'll need and how to achieve that goal. Create your own personal financial vision for the next decade with MyBlocks, our free tool at riaadvisors.com. That's riaadvisors.com.
The Real Investment Show.
All right, welcome back to the show this morning. A couple of things that are kind of interesting that are going on. Brent puts some notes up on my screen every day, just little tidbits of information. He put an interesting quote up from Axios. This was from November 21st of 2020. It says, even in the face of the pandemic, financially, most Americans are doing surprisingly well. Americans' disposable income was $15.7 trillion per year in September, up significantly from the pre-crisis levels. Average earnings are $29.50 an hour, up from $28.69, and that was in March. And with credit card balances plunging, Americans have managed to save 14.3% of their income in September, roughly twice the pre-crisis savings rate. So, a couple of things. If that's the case, then why are we in such a rush to do more stimulus from the government? Because if you listen to the mainstream economists, we're on the verge of a economic collapse if we don't get some more deficit spending out there and run up some more debt for the government, right? So just yesterday, the Democrats have proposed a $900 billion package to include $600 a week in unemployment benefits. That was shot down by the Senate pretty quickly by Mitch McConnell. So again, probably not going to go anywhere anytime soon. We'll probably wind up. And again, what's interesting about the $900 billion is that's down significantly from the $3 trillion where we started and what Nancy Pelosi wanted. Now we're down to $900 billion, and we still can't get that passed.
Well, I think Nancy's at $2.2 trillion still, and you have McConnell at $500 billion.
Yeah, well, Nancy's on her own planet. So, but the point is that if we're going to do stimulus spending, right, do we really need to do it? If we take a look at, the economic growth, take a look at the stock market, whatever it is, right? Manufacturing is back to pre-pandemic, actually higher than we were pre-pandemic. Service sector activity is back to previous highs. Retail sales, we just did a record number of retail sales online post-Thanksgiving. So before we go further into debt, right, and add up more debts and more deficits, I know there's this belief that, oh my gosh, we got to bail all these people out. Yes, there's 20 million Americans that are on the cusp of potentially losing their homes. That's 20 million Americans out of 330 million, right? And so, we need, if we're going to do more of these benefits and more stimulus and more spending, it needs to be very targeted and very specific to what you're doing. One of the things that has been kind of a sticking point for the Senate is bailing out cities and municipalities. You don't need to bail out a city or municipality. They can issue debt in the open market, right? They can go to market, they can issue municipal bonds, they have the facilities already set up, they get very rapid approvals by the SEC for the issuance of their bonds, et cetera. They can raise capital. They don't need a bailout. They just don't want to do it. If you're going to give me free money, great. I don't have to go further into debt in order to get money, right? But you have the ability to do that. You can raise taxes. You can issue debt. You have lots of opportunities to raise capital for a city or municipality. You don't need to bail those out. Those don't need to be on the back of taxpayers. If we're going to provide more money to individuals, then we need to be very targeted and specific about how it's done, because, again, it's the taxpayers that wind up paying that tab. And despite the belief of a lot of these economists that debt doesn't matter, that simply we can just print money to pay off our debt, it has consequences. Its consequences are slower economic growth, wider wealth gaps, lack of prosperity, et cetera. The same thing we've been seeing over the last decade. It's not going to improve. But there are some things about these stats that are also important to understand. Is that a lot of the wage increase and a lot of the debt reduction isn't for the average American. It's in the top 10% of income earners. A big chunk of the savings rate is in the top 10% of income earners. So there is the issue of what's going on with the wealth gap in the country, and that's also problematic. That's also why we've had a lot of social unrest over the last decade, et cetera, because of this burgeoning wealth gap beginning to really work its way through the economy. And again, the policies that we're doing, more debts, more deficits, is going to exacerbate that problem, not make it better. Thought it was interesting yesterday, Janet Yellen, they were talking about Biden's picks for his economic team. And Janet Yellen is the top pick for the Secretary of the Treasury, who will then work hand in hand with the Federal Reserve. And I loved her comment yesterday. She's like, I am all about creating economic recovery and prosperity and employment for the American people. Really? Because the whole time that you were Federal Reserve Chairman, the wealth gap got wider and economic prosperity worsened because of the policies that you ran. It was interesting when Trump was running for president, he says, yeah, Janet Yellen blew a big, fat, ugly bubble. And we just made it bigger over the course of the last few years. But that exacerbation of the wealth gap has been a direct translation of these ongoing economic policies that have proven not to work. Yes, it inflates stock markets. And for 10% of the population that actually own 88% of the stock market, it's been great. Just not so much for everybody else. And so this is part of the problem we have to deal with, and particularly as we go into the next few years, is we do have to, despite the fact there's a lot of people that want to promote this idea of modern monetary theory, which says that the government's debts are somebody else's asset. That's true. And the moment that you forgive that debt or you don't pay that debt or whatever, you destroy the person's asset that owns it. There's two sides of every coin. There is no free lunch in any of this. And the more debts and deficits that you run up, the weaker your economic prosperity will be. And that's been proven for the last 40 years when we started running deficits in this country. So it's something to think about. Well,
and you mentioned the people that are on the cusp of losing their homes, the people who are going to be evicted. I mean, I think it is that K-shaped recovery because you've seen that, you discussed the wealth gap, and especially what Janet Yellen has done. And we still have issues, and that's why I believe that they're looking at targeted reform or stimulus here versus just throwing a blanket out once again, because we saw a lot of states that were having issues where you couldn't bring employees back because they were making more money on unemployment. There was no incentive for them to get back to work because they said, hey, I can sit here and take a break, free vacation, not have to come back.
That's part of this. The bill that was introduced by the Democrats was to extend the $600 weekly benefits, and that's exactly what happened.
All the way through the end of next year.
Right. And that just keeps people out. See, and that's one of the big problems with bailouts and stimulus is that it creates non-productive behavior. If you give somebody money, that creates non-productive behavior because it doesn't require me to go produce anything. You're just going to give me money. And the problem with stimulus programs is that once you do these things, you got to keep doing them because as soon as the money runs out, nobody's producing, right? And this is why socialism always fails. You've got to create productive activity. People have to produce something in order to get paid before they can consume. And when you violate that chain, when you create an effect that reduces the productivity, the production side of that activity, you get slower economic growth. Yes, people have money to spend, but because they're not producing anything, you get slower economic growth out of it. And this is why over time, stimulus and these type of things actually have a negative multiplier effect in the economy, which is why you keep getting slower rates of economic growth.
Now, do you think that retail sales number that this last week, do you think that's accurate?
That's all credit.
Yeah.
That's going to be, you'll see credit card balances jump over the next month.
But the week prior to that, retail sales numbers were down.
Yeah.
And we saw unemployment numbers were up. Yet, so we have I think there's two different things happening.
Oh, yeah. Well, no, we'll see. Well, first of all, we're going to see a lot of revisions to this data. And we always do. Every year we get these initial estimates from Adobe and the National Retail Federation. Biggest shopping day of the year after Thanksgiving. And then a month later we get revisions and it's like, oh, well, it really wasn't all that strong. But nobody cares about the revisions. But yeah, so you're very likely the numbers that were touted, which are just estimates, they have no idea. They haven't calculated the actual totals
why don't
yet.
you let people know how they actually come up with most of this information?
It's throw a dart at the dartboard.
But don't they? A lot of times it's economists who they go and poll different economists, say, okay, what do you think GDP was? What do you think this was? And then they come back and actually give you the real number for GDP, which was way different than what somebody guessed. Well, I think it's going to be this.
Yeah, GDPs especially. The first estimate, we do 3 estimates of GDP. The first one is all just economist guesses. Wow. The third estimate actually has data in it. So, by the time you get the third estimate, you're there. But yeah, so a lot of these numbers, but we don't care about revisions. Nobody cares about past data that gets revised down. We just want to know what the number is now. So very likely we'll see these retail sales revised down in the next month or so, and they won't be as strong as. But again, nobody will actually care about that. But the important thing here, though, is that there's part of this process. Look, purchase applications for houses are at a record right now. And the price of the houses being bought are at the highest level in history, right? The average home price is $375,000. Now, think about this for a moment. The average house price is $375,000. The average median income is about $59,000 a year. So the problem is always this, and this is what happens when we get into these real estate bubbles, et cetera, is that people, because of low interest rates and because of easy credit terms and these type of things, people buy houses they really can't afford. It sounds cheap, right? I can buy a $375,000 house and my monthly payment's only going to be $1,200 a month or whatever the number is. Sounds fantastic. But then you have to include maintenance, taxes, all these other things that go into owning a house that far outstrip their ability to maintain that house on their salary and on their income. And this is why when we get into a problem economically, these houses immediately go into foreclosure or they wind up missing payments, etc. And this is why you have 40 million people right now in moratoriums and on delinquent payments of houses. And when that moratorium lifts next year, there's going to be a big number of evictions that occur because they bought houses they can't afford. And part of this process, the cleansing process, is that sometimes you got to let these things actually occur to fix the economy longer term. Nobody wants to do that, though. That's no fun. Not around Christmas. Anyway, be right back. We'll be back tomorrow morning for the next edition of The Real Investment Show. Get by the website, realinvestmentadvice.com. For all of our podcasts and more, realinvestmentadvice.com. We'll see you tomorrow.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for the Real Investment Report now at realinvestmentadvice.com.
It's a rich man's world.